If you are confused about CPR's policy regarding the reenactment of the statutory reserves through the Bank of Canada, please consider these questions. What were the statutory reserves? When were they abolished? Did they provide any benefit to Canada? Should the statutory reserves be reinstated? The statutory reserves were a percentage of the deposits the banks received from the public that had to be redeposited on an interest-free basis with the Bank of Canada. Typically, the rate was around 8%. The statutory reserve rate was flexible and provided an important tool to the government for stabilizing the value of Canada's dollar. It also provided the government with hundreds of millions of dollars of interest-free capital per year. The statutory reserves were phased out by the Mulroney government over a 2-year period starting in 1991. Yes, they helped the Canadian government stabilize the value of the dollar by giving the government a precision instrument to help fight inflation. How did they provide this? Consider this example. Suppose the housing market in Western Canada is booming, and the government fears inflation will rise soon because of it. With statutory reserves, the government has 2 options for dealing with the situation. The first is to raise the Bank of Canada's benchmark interest rate, also known as the bank rate, which will cause interest rates in general to rise. Rising interest rates mean people are less willing to take out a mortgage, and the housing market will begin to settle down. However, those higher interest rates hit everyone in the economy, not just the housing market. With every 1% rise in the bank rate, tens of thousands of people will lose their jobs. Talk about curing the disease and killing the patient. This is why the manipulation of the bank rate is often referred to as a blunt tool for dealing with the economy. It's like using a butcher's knife for brain surgery. The statutory reserves used to provide a precision tool needed for scenarios like this. Instead of raising the interest rate, the government used to have the option of raising the statutory reserve requirement, say from 8 to 10%. That would cause banks to have less money for mortgages, which would provide some relief from mounting inflation, without having to lose tens of thousands of jobs in the process. Better yet, the government was able to specify to the banks that the rate change applied only to a particular market, like in this case the overheated housing market in Western Canada. The banks would have to keep a certain amount more from housing-related deposits, the amount available for mortgages would decline, and the amount of money available to other sectors would remain unchanged. This sector-specific adjustment capability was highly effective during the period it was used from 1938 to 1991, and it is sorely missed by many people in Canada today. The Canadian Party for a Republic believes strongly that the statutory reserves should be reenacted in Canada. If you agree with our views on this issue, please join our party and support our efforts. Thank you.